Now, let's take a look at the incentives from ROI and economic profit. In order to measure and evaluate the performance of each division, we use ROI and economic profit. Also, we can give some incentives using the performance measure. Okay, consider two divisions of a company with the following data. Suppose each division is considering a new proposed project. Division X is considering project A that will earn 15% after tax annually on a $500,000 new investment. Division Y is considering project B that will earn 7% after tax annually on a $800,000 new investment. Okay, compute performance measure of ROI and economic profit. We have X and Y division without, let me remove this first. Then let's restart. We have a division X and Y without a project A and with project A, so that we can get the insight about these incentives. If we have this project A, then is this ROI get better or economic profit? If division Y adopt this project B, without comparing with our project B, the division Y's return on investment to economic profit gets better. So that's what we want to analyze. So division X and Y cases are independent. Let's go. So without project A, we want to get first capital charge to calculate what? Right, the economic profit. And that return on investment can be calculated. Net operating profit after tax divided by invested capital. It's very easy. So let's go step by step. The capital charge, invested capital times, we have the cost of capital 10%. So $100,000 is the capital charge. The net operating profit after tax was $200,000 without project A. So we can just subtract this $200,000, $100,000. Now the economic, we have to put here 200,000 minus 100,000. So economic profit is $100,000 without project A. Then return on investment is return on 200,000 divided by invested capital. So let's change as a percentage. Now, as you can see that this 20% means it's $1 of investment create income 20 cent. Okay, and then economic profit $100,000. If this division X decide to put the project A into the division X, then what would happen? Then we want to adjust this without project A. How do you get it? 200,000 plus. Now we have a new project, the $500,000 for the division X. So 500,000 times 15% is after tax. So we get the net operating profit after tax. Okay. So 275,000 is new net operating profit after tax. How much is the invested capital? $1 million existing invested capital for division X plus new additional amount of invested capital is 500,000. So the total invested capital with having this project A is 1.5 million. Now capital charge is just 10%, the same. So we got it. So new return on investment, net operating profit, I'm going to just drag to the right, then to the right. So we got the return on investment result is 18.33% for the division X if division X added project A into this division. So they would not choose this project A because if the company evaluate the performance of this division X by the return on investment only, this total return on investment of the division 20% now is decreasing to 18.33%. There's no reason to take this project A. But if the company evaluate the division X by this economic profit, so it has been increased $125,000. $25,000 additional economic profit has been increased. So why not? Why not? That's why the company should evaluate not only the return on investment as a performance measure, but also economic profit. Okay, so let's practice one more time without the project B for the division. Now we can just drag to the right. So 80, and then we also just drag to the right. The same way. Without the project B, the economic profit was negative 40,000 and return on investment was 5%. Pretty low, pretty low. Then what would happen if the division Y add this project B to the division Y? So once again, this $40,000 should be increased by $800,000. New investment times 7%. So 96,000 is new net operating profit after tax for division Y. Then the invested capital existing amount was $800,000, should be added to $800,000 new amount of invested capital. So total is 1.6 million. So automatically calculated capital charge is 10% of this invested capital. So 160. Now return on investment. Return on investment is 6%. It has been increased. But what would happen if the division Y increased the project B, and then the company evaluates this performance of the division Y by this economic profit? Then, this $40,000 economic profit now has been deteriorated. So $64,000. So let's discuss about this question once again. Performance evaluation is based on ROI. Would the manager of division X and Y invest in this project? So again, the division X should not invest project A. Even though project A earns a return of 15%, which is above 10% cost of capital, it decreases ROI for division X from 20% to 18%. So there is no reason to take this project A into consideration. Division Y should invest in project B if performance evaluation is based on ROI. Even though project B earns a return of 7%, which is below 10% cost of capital, it would increase ROI a little bit better from 5% to 6%. Okay. In general, the ROI profitability metrics that provides an incentive for divisions to invest in new project that earns a return in excess of their current return, rather than an incentive to invest in a new project with a return in excess of the cost of capital. because anyway, this return on invested capital, if the return on investment has been increased, then the company, the division that has increased this return on investment definitely take a new project regardless of cost of capital percentage. Number 3, performance evaluation is based on economic profit. Now we have a totally different story. The manager of division X should accept the project A because it has been increased from 100 to 125, even though this return on investment percentage has been decreased. Even $1 has been increased from economic profit, definitely has been increased because that is the evaluation, the criteria. So the manager of division Y should reject project B. Why? Because $40,000 negative the economic profit, negative, this economic loss has been deteriorating, right? So there is no reason to take this new project B. Okay, like this, it depends which performance measure that the company the evaluate with. So we need to analyze this incentive from ROI economic profit in this way. Okay, see you in the next video clip. Bye-bye.